Hey everyone, and welcome to today's video. In recent weeks, we have seen a lot of panic and volatility in the banking industry with the collapse of Silicon Valley Bank and the emergency rescue of Credit Suisse by UBS sparking fears of contagion. This has led many market watchers to question whether we are seeing a true banking crisis or simply a sentiment contagion driven by irrational market behavior. In this video, we will explore the recent headlines and try to understand what is happening in the banking industry. We will discuss the difference between a true banking crisis and a sentiment contagion and why it matters. We will also examine the factors that have contributed to the recent panic and what it means for investors. First, let's start with the basics. What is a banking crisis? A banking crisis is a situation where a large number of banks or financial institutions experience significant financial distress or fail altogether, leading to a widespread loss of confidence in the banking system. This can be caused by a variety of factors, such as economic downturns, asset bubbles, or excessive risk-taking by banks. One of the most recent and well-known examples of a banking crisis is the 2008 financial crisis. During this time, many banks in the United States and Europe suffered significant losses due to the subprime mortgage crisis and excessive risk-taking. This ultimately led to a global financial crisis and a severe economic recession. Other examples of past banking crises include the savings and loan crisis of the 1980s in the United States, the Asian financial crisis of the late 1990s, and the European sovereign debt crisis of the early 2010s. The typical causes of a banking crisis are bad loans and excessive risk-taking. When banks lend money to individuals or businesses who are unable to repay the loan, it can lead to significant losses for the bank. Additionally, when banks take excessive risks, such as investing in complex financial products or taking on too much debt, it can also lead to significant losses. Now that we have a better understanding of what a banking crisis is, let's dive into the recent headlines and explore the concept of sentiment contagion. Many market watchers are questioning whether the market is operating on sentiment rather than fundamentals when it comes to fears of a systemic banking crisis. According to Sarah Devereaux, global head of the fixed income group at asset management giant Vanguard, the banks in recent headlines had risk management issues with traditional assets, and the banks were forced to become sellers, realizing losses after their bond investments were well below face value. CD also concluded that in the absence of a clear explanation for Friday's moves, what we are seeing is an irrational market. As we witnessed with CS, the risk is if there is a knock-on impact from various media headlines on depositors psychologically, regardless of whether the initial reasoning behind this was correct or not. Recently, the collapse of Silicon Valley Bank and Credit Suisse's emergency rescue by UBS sparked contagion fears in the banking industry, causing a sell-off in banking stocks. Deutsche Bank was the next target, with shares plunging and the cost of insuring against its default spiking, despite its strong capital and liquidity positions. Market watchers are questioning whether the market is operating on sentiment rather than fundamentals when it comes to fears of a systemic banking crisis. The current situation in the banking industry is being influenced by various factors, including the collapse of Evergrande, a major Chinese real estate company that is facing a debt crisis. This has led to fears of contagion in the global financial system, as the company owes large amounts to various banks and bondholders. The potential risks and impacts of the current situation in the banking industry are significant. If there is a widespread default in the financial system due to contagion, it could cause a global recession, similar to the 2008 financial crisis. Additionally, banks that have exposure to Evergrande or other high-risk companies may face significant losses, which could lead to a credit crunch and difficulty in accessing credit. This, in turn, could have negative effects on economic growth and employment. It is important for regulators and financial institutions to take swift action to address these risks and prevent a systemic crisis. It is worth noting that, according to experts such as Sarah Devereaux from Vanguard and Dan Scott from Vontobel Multi-Asset, the current situation is more of a sentiment contagion rather than a true systemic contagion. Banks in recent headlines had risk management issues with traditional assets, and rapidly rising rates exposed those weaknesses. The banks were forced to become sellers, realizing losses after their bond investments were well below face value. While the situation is concerning, the damage has been largely contained thanks to the quick action of federal agencies and other banks. However, it is important to remain vigilant and take necessary precautions to prevent a potential banking crisis. According to recent reports from CNBC, there has been a surge of sell-offs in banking stocks due to fears of sentiment contagion in the market. The collapse of U.S.-based Silicon Valley Bank, the biggest bank failure since the global financial crisis, and the emergency rescue of Credit Suisse by Swiss rival UBS sparked these fears. Sentiment contagion refers to the spread of negative emotions, such as fear or panic, through social media and public opinion, leading to a decline in investor confidence and stock prices. In this case, negative sentiment can spread quickly through social media, creating a ripple effect that affects investor behavior. For example, rumors or negative news about a particular bank's financial situation can spread rapidly through social media platforms, leading to a loss of confidence in the bank's customers and investors. This can then lead to a sell-off in the bank stocks, creating a domino effect in the market. Regulators can play a crucial role in monitoring and addressing sentiment contagion. They can monitor social media channels and news outlets to detect rumors and misinformation that can affect investor confidence. They can also work with banks to ensure that they have adequate risk management strategies in place to mitigate the impact of sentiment contagion. To wrap it up, the recent turmoil in the banking industry has led to widespread concerns about a potential banking crisis. However, it appears that the current situation is more of a sentiment contagion rather than a true systemic crisis. While there are certainly risks and challenges facing the banking industry, particularly in the wake of the COVID-19 pandemic and other global economic pressures, it is important to remember that the industry has undergone significant reforms and regulatory changes since the 2008 financial crisis. Ultimately, it is impossible to predict the future with certainty, but by remaining vigilant and proactive in their risk management and other practices, banks and other financial institutions can help to ensure the stability and health of the global economy in the years to come. Thank you for watching. See you in the next one.